Welcome to EVNTAlpha, where I cover economic news and data, the S&P 500, and stock trading signals with captivating historical performances. With the S&P at a crucial technical spot for its current rally, this next week is one of the most pinnacle times in its history. With the soft CPI and PPI report earlier this week, we saw a major dovish shift in rate hike sentiment, and just when it seemed a bullish setup was around the corner, geopolitical tensions re-escalating has reeled us back into reality, posing more and more of an issue as the days go on. With semiconductors seemingly ready to break down even further, is the S&P ready to take a big hit, or is this just another buy the dip opportunity? Yesterday after market close, Trump made his big announcement in which he focused on election security as he continues to harp on the idea that the election was stolen from him in 2020. The White House will be providing newly declassified documents in which Trump claims highlights China accessed U.S. voter data in an attempt to influence the 2020 election and alleged voting machine vulnerabilities and manipulation. U.S. intelligence agencies have confirmed that no foreign powers tried to interfere with ballots or vote counting, and which our ballot systems are very secure and difficult to breach. Now, there's a couple reasons why these accusations and narrative is not only very bad for the U.S. as a whole, but bad for markets, is one, this undermines U.S. citizens' confidence in our voting system and voting security off of conspiracy and unconfirmed claims. There is a fundamental flaw in his argument in which if there is a mass effort to rig elections against him, how did he win 2 times? Were the times he won counter-rigged in his favor? And so on. I think you get the point on how this is very dangerous rhetoric for the sanctity and integrity of our election systems. This is also bad for markets because he is escalating tensions between China at a time when geopolitical tensions are already high with Iran. His words could ramp up trade tensions between the world's 2 biggest economies, creating even more of a geopolitical controversy on top of what we're already dealing with. Terry Haynes, founder of forecasting firm Pangea Policy, noted, Trump's speech is negative for the markets because it raises 3 questions. Why focus on China as the main culprit? Why now? And what's the fallout on already fragile trade and geopolitical U.S.-China relations, including U.S. hopes that China continues to pressure its client state Iran? This article on MarketWatch brings up some really good major points about this whole development, in which it goes on further saying Iran is highly dependent on China, who is the number 1 buyer of the Middle Eastern nations' crude oil, as well as the top buyer of oil that is shipped through the Strait of Hormuz. With that being said, antagonizing the largest client of Iran certainly does not help, given they could add pressures to Iran to come back to the talking table instead of resorting to violence. China on Friday rejected Trump's allegations, with a spokesman for the country's foreign ministry saying that U.S. should stop making an issue of China in its elections and do something conducive to China-U.S. relations. These accusations couldn't be at a worse timing as the Iran conflict continues to escalate further, as it was reported by CNN that attacks have expanded to Qatar, Kuwait, Jordan, and U.S. assets in Bahrain and Oman, and what appears to be its largest strikes in the region since talks with the U.S. collapsed. Many Arab allies condemned the Iranian strikes and renewed calls for the return to dialogue, including Qatar, UAE, Jordan, and Kuwait. So not only are we seeing escalation between the U.S. and Iran, but also between Iran and other Arabic countries. I hope a diplomatic solution can be made and the violence can end. This is why it's important to remain cautious in the markets at the moment, as conditions are changing incredibly rapidly and we really don't know what's going to happen next. As a result, we saw oil futures continue to rise today, nearing our next resistance zone, just about 84.5 to 89.5. U.S. retail sales was also released this morning, and it was reported in line with expectations, as well as a drop from our previous reading showing some slowing in retail growth. This could be an early warning sign of a fall-off in consumer confidence, hence a fall in sales growth and demand. So watch out, as further signs of U.S. consumers feeling the pressures of inflation can certainly cause a dip in the markets further. Initial jobless claims came in lower than expectations, showing that we are seeing signs of the labor market continuing to improve. While this shows a strong economy and is generally bullish, remember this also, on the other hand, gives the Fed more confidence in the ability to hike rates if they find necessary due to any shock to inflation the recent developments may cause. Amidst the bearish news and controversy, we saw the S&P break down below the yellow zone we've been talking about and retest the trend line of our bullish triangle breakout. We did get a bounce off of it, keeping the bullish triangle in play, as once we close below the trend line, that is when it is invalidated. However, notice the major rejection wick at 61.8 and close below it. This is a fairly bearish break, as like I've said in the prior videos, if we start closing below the yellow zone, it is very possible we go on to retest the green zone again at 73.67 to 73.10. Now the ABCD pattern we've been talking about is somewhat out of the picture now in the meantime, since we rejected B and failed to close above. Now what we want to pay attention to over the next 2 to 3 days is if we start trading back above 61.8, or if we break down below the trend line and go on to retest the green zone in the 7300s, similar to June 15th of this year. If we fail to bounce off the green zone, it is very likely we're breaking into new lows since the beginning of June. One of the biggest contributors to the sell-off today was semiconductors, which are getting absolutely crushed due to profit taking on how extended their valuations had become. In addition, with capital expenditures exploding in AI due to development and hardware costs, it's in question how much further spending we could see. A deceleration in capital spending means a likely deceleration in hardware acquisition needs. If you are familiar with basic trend theory, you probably noticed we have technically entered a downtrend. For those who are unaware, to summarize, in an uptrend you have higher highs and higher lows. In a downtrend, vice versa. Now, if you mark the lows that were created before the break into the next high, this is in essence a barrier in which until you cross back below, you assume we're in an uptrend and look for long opportunities. In this case, notice we have broken below our low created in June that marked the pivot before reaching all-time highs, hence with the pivot that created our higher high, right, indicating that we have now shifted into a downtrend. I also drew a Fibonacci retracement from the trough in April to the peak in July, highlighting how intense this semiconductor run has been. Notice how we are rejecting the 38.2 currently as the market attempted to buy back above of what is now being treated as a resistance zone. If we continue to reject here, it's likely we go on retest the 50% retracement along with our next pivot low that occurred in the uptrend. If profit taking continues to accelerate and we continue to get bearish sentiment shifts, it's certainly possible given how extended the index has gotten. To add more bearish indications to the fire, notice we confirmed a head and shoulders pattern in which you have two shoulders, a head, and a neckline. Whenever you break below the neckline, it calls for a drop equivalent to the distance from the peak of the head to the base of the neckline. So I went ahead and copied this exact trend line and placed it at the point of break, and this brings a downward target to roughly 10,190. Now with head and shoulder patterns, the target is not always met, and until there is a confirmation close below the 50% retracement, that target should not be implied. Currently the focus now is how we close around this resistance zone the next few days, as failure to breach back above could indicate further downturn is in the near future. So the only new trigger I want to talk about today is Microsoft, in which we saw a buy signal from a strategy I call all-time high drawdown, in which in the second panel you're seeing how far down price will draw down from a all-time high once it's been realized, right? So that's our green line. And so if this says negative 20, right, we're 20% below what all-time highs were. And so in particular for Microsoft, whenever you've seen it drop more than 25% from its all-time high and pick up momentum against its own moving average, it rose on average just about 20% over the next 118 trading days. Over the past 7 years, we've seen 4 of these triggers in which 3 of the 4 the price was higher. Now we got a 5th, 6th, and 7th all bunched recently, one being on March 17th, one being on April 17th, and one being today, July 17th. Now these 3 aren't being incorporated in the statistics as they have not finished out a 120 trading day period. to be incorporated in the analysis, right? So we're still actively watching these play out, as you'll see in the next slide. So taking a look at Microsoft reactions to those buy signals, on the x-axis we have trading days out from the signals, and on the y-axis we have your cumulative percent change. In other words, what you're viewing here is what your returns would be if you had bought Microsoft in each one of these buy dates and held for 120 trading days. Now in blue, that's the average return across the 4 historical triggers we realized. Remember, the yellow ones, which are active triggers, are not being incorporated in these statistics just as of yet. So you can see in blue that leads up to that just about 20% on the 118th day, 19.9%. And in yellow, you can see the 2 active triggers that have been playing out, one jumping up about 15%, the other 2 jumping up in close line with our historical max returns at about 9%, right? And so with that being said, right, it's a fairly low sample size, and you're seeing a lot of volatility in the first month on both ends, right? So definitely be careful preemptively entering any longs. But ultimately, what we've seen historically speaking across those 4 signals was more likely to see the price higher leading into month 6, right? And so, you know, based off what we've seen in these past reactions, even the most recent ones, right, it's more than capable of having some spikes back up towards closer to this average. So it'll be interesting to see over the next 6 months, as well as the next 2 months for this last trigger, if that's something that we see. So I went ahead and plotted what that 19.9% on average would look like, bringing Microsoft to $472.50 a share leading into January of next year. On the downside, I put a 10% stop loss, about a 2-to-1 ratio, as we saw drawdowns of 10% in these most recent triggers before it went on to have a spike higher, right? And so based off the reactions we've been seeing, it's fairly capable and possible. We do see a jump up to this next resistance zone and a potential break outside of this trend line we have developing here. If we do break above this trend line, that implies we go on to retest the highs that were created along the way, right? And on the downside, if we go and continue to reject off this resistance zone currently, that implies maybe we go on to retest our support zone one more time. And if we hold there, maybe, you know, a build structure first before it can go on to break outside and test some of these higher resistance zones. Microsoft's a fairly strong company with very long, historically strong growth. And it's at one of its lowest valuations it's been in years relative to EPS. And so Microsoft's definitely one of those stocks on my radar that I will be keeping an eye out to see how, you know, this setup plays out, and if we do in fact get a breakup outside this resistance zone. That is everything for today. If you enjoyed the video, please give it a like and subscribe, and I hope to see you in the next one.